Hey there, welcome to our channel, where we try and demystify the world of finance for you. In this video, we're going to tell you the history of Forex. The foreign exchange market, or Forex, is the largest financial market in the world with an average daily trading volume of over $6 trillion. But have you ever wondered, how did it start? Well, let's get right into it. The story of Forex begins in 1950s, just after the devastation of the Second World War. At that time, the international monetary system was in sharp need of a repair. Before the Second World War, most countries had a system of fixed exchange rates. Under such a system, each country's currency is pegged to a precious metal like gold at a predetermined rate set by the government. So, for example, if the official rate between USD and gold is 1/34th ounce per dollar, and the official exchange rate between GBP and gold is 1/28th ounce per pound, then 1 USD would equal 1.33 GBP. Since the value of gold never fluctuates, neither do the currencies which are pegged to it. However, the outbreak of the Second World War broke this favorable stability. During the war, many European countries suffered significant damage, and their currencies became almost worthless. The British pound, for instance, depreciated so much that in 1945, it took $30 to buy 1 pound. In order to stabilize the market, governments imposed capital controls and other restrictions on currency conversions. These measures allowed them to maintain stable exchange rates without actually having to back those rates with gold. But they were only temporary solutions. By the end of the war, most countries realized that the old system of fixed exchange rates was no longer tenable, and that a new system needed to be established. On July 1944, delegates from 44 allied nations met up at the Bretton Woods Conference in New Hampshire to design a new international monetary system. This conference gave birth to the system that we all know today, the floating exchange rate system. It allowed countries more freedom in setting their own exchange rates. However, it also brought with it greater volatility. Currencies were now subject to market forces of demand and supply. And by 1971, when the United States ended the convertibility of its dollar into gold, it led to a floating exchange rate system where the value of currencies was determined by the forces of market supply and demand. As currencies started fluctuating against one another, trading opportunities arose, and thus the foreign exchange market was born. Initially, the Forex market consisted of large commercial banks and central banks, who traded currencies to facilitate international trade and investment. During the early days, transactions were done over the phone and telegraph. They traded only major G10 currencies. That is the currencies of major developed economies. These include the Australian dollar, Canadian dollar, Swiss franc, pounds sterling, Deutschmark, Japanese yen, US dollar, and the euro. However, as the years passed, the Forex market began to grow and evolve. In the late 1970s, following the collapse of the Bretton Woods system, the market grew exponentially. More and more smaller banks entered the market because of growing instability and high inflation. By the mid-1980s, Forex trading was dominated by London, New York, and Tokyo. These three cities accounted for over 80% of global foreign exchange trading. The Bank for International Settlements reported that by 1989, the average daily turnover had reached $600 billion. It was around this time that the first electronic trading systems were developed. These systems made trading faster and more efficient. Soon enough, non-bank institutions also started participating in the Forex market, including corporations, pension funds, hedge funds, and investment banks. This period also saw the emergence of the over-the-counter market, where currencies could be traded 24 hours a day, 5 days a week. By the turn of the century, thanks to technological advancements, Forex trading was now open to retail traders like you and me. Today, anyone with an internet connection can access the market and trade from anywhere in the world. With the introduction of easy-to-use platforms, Forex trading has become very popular among individual traders who want to try their hand at investing. According to statistics published by the Bank for International Settlements, the average daily trading volume in the Forex market is now well over $6 trillion. It is truly a global market that operates 24/7, bringing together millions of traders from all corners of the planet. Let's take a look at some of the major milestones in the history of Forex. In 1971, the United States abandoned the gold standard. This led to floating exchange rates and the creation of the modern Forex market. In 1973, the European Economic Community introduced the European currency system, which eventually led to the creation of the euro. This event had a profound impact on the Forex market, as it reduced transaction costs for European traders and investors. In 1992, the United Kingdom joined the exchange rate mechanism, further integrating the European currency market. In 1999, the euro became the official currency of 11 EU member states, and the single currency system paved the way for the launch of the European Central Bank. The year 2000 marked a significant milestone in the history of Forex trading, as retail traders started entering the market. The advent of ECHU's online trading platforms made Forex accessible to individual traders. Around the same time, High-frequency trading also emerged as a prominent feature of the Forex market. In recent years, the Forex market has witnessed the rise of Islamic finance, which offers traders the opportunity to trade according to Islamic principles. Now that we've covered the basics, let's talk about the key players involved in Forex trading. First, we have the central banks. These are the highest authority in the Forex market, responsible for controlling the supply of their respective currencies. Then we have commercial banks. They facilitate Forex trading for businesses and individuals. They make money by buying low and selling high, profiting from the spread between the buy and sell price. Next come the multinational corporations. These companies require Forex trading to facilitate international operations such as imports and exports. They often use natural hedging techniques to manage exchange rate risks. Then we have the investment banks, which are primarily responsible for underwriting securities and providing advisory services during mergers and acquisitions. Hedge funds are also key players in the Forex market, as they use sophisticated trading strategies to generate high returns. Finally, we have retail Forex brokers, which are companies that provide platforms and services for individual traders to participate in the Forex market. They offer leverage to traders, allowing them to control larger positions than their account balance would normally allow. There are also several regulators that oversee the Forex market to ensure fairness and transparency. These include the National Futures Association, the Commodity Futures Trading Commission, the Financial Conduct Authority, and the Australian Securities and Investments Commission. These organizations establish rules and regulations that market participants must follow to protect traders and maintain market integrity. So what are some of the benefits of trading Forex? Firstly, Forex is a highly liquid market, meaning that traders can easily enter and exit positions without affecting the price. This liquidity also ensures that traders can quickly respond to changing market conditions. Secondly, Forex trading offers high leverage, which allows traders to control large positions with a relatively small investment. However, it's important to note that while leverage can amplify potential profits, it can also magnify losses. Thirdly, Forex trading is a 24/5 market, providing traders with ample opportunities to trade throughout the day. This flexibility allows traders to accommodate different time zones and lifestyles. Moreover, Forex trading is a decentralized market, meaning that there is no central exchange or intermediary. This allows for more competitive pricing and tighter spreads. Additionally, the use of technology in Forex trading has made it possible for traders to access real-time data and execute trades quickly. This technological advancement provides traders with the necessary tools to stay informed and make quick decisions. Furthermore, Forex trading offers various trading options, including currency pairs, spot trading, margin trading, and futures. This diversity allows traders to explore different strategies and find what works best for them. Lastly, Forex trading can be a profitable venture with potentially high returns on investment. However, it's important to remember that success in Forex trading requires knowledge, experience, and effective risk management. If you want to start trading Forex, it's crucial to educate yourself and practice on a demo account before diving in with real money. It's advisable to choose a reputable broker with a proven track record and a user-friendly trading platform. Additionally, consider factors such as customer support, account types, and trading instruments offered by the broker. You should also develop a solid trading plan. Learn how to read charts and analyze technical indicators. It's essential to understand market psychology and consider factors such as economic news and global events that can impact currency prices. Start with small position sizes and gradually increase as your confidence and experience grow. Always use risk management techniques, such as stop losses, to limit potential damages. Stay informed about market trends and be prepared to adapt your strategy as needed. Continuously evaluate your trading performance, learn from both successes and failures, and refine your approach over time. Consider joining a community of Forex traders to exchange ideas, ask questions, and stay motivated. And there you have it, folks. Thank you for watching this video. We hope that you enjoyed learning about the fascinating history of Forex. If you found this video helpful, please don't forget to leave us a thumbs up. We'd really appreciate it. And while you're at it, why not subscribe to our channel? That way, you'll never miss out on any of our future videos. Thanks again for tuning in, and we'll see you next time.